So I want to talk about some tactics for shorting the stock market. And really, the key idea to drive home is that from a stage analysis perspective, the best time to get short is when the market is above the 30-week moving average, but the 30-week moving average is declining. So, for example, you can see in this chart of stage analysis, once the stage 3 top completes and the price action moves up above and below the 30-week moving average, but the 30-week moving average flattens out, then it goes into decline. And the best time to get short is not on these deep, um, smash downs below the 30-week moving average, but actually above the 30-week moving average when everyone thinks that the worst is over and CNBC stops running specials on how horrible the market is and everything's fine again. This is when you want to get short. Well, let's look at some past bear markets and kind of, understand how this works. So if you look at like the 2000 to 2002 bear market in the S&P 500, you can see the topping action back in the year 2000, and then the market broke below the 30-week moving average and it started to go into decline. And you can just see on this chart that the best times to get short are when the market action, climbed back up close to the 30-week moving average, which starts to act as resistance as the market goes into a bear market. So it's tempting to get short down here when everybody is pessimistic and thinking the world's going to end, but that's where the shorts get killed. And when the market rallies back above here is when people think that things are okay, but in reality, this is where you want to enter short positions to maximize future profits. And the key is that if you do end up getting short down here, look how long you have to wait, even if the market is in a bear market, to capture more profits. For example, in this case, if you got short the S&P 500 in April 2001, you're going to be flat to down all the way, unless you sold down here, but all the way into 2002 for about a year. Price essentially went sideways with a lot of volatility. So to minimize mistakes in playing the downside, you have to wait for these big reaction rallies and better shorting opportunities. Um, Looking at the 2007 bear market, which started in 2007 and into the 2009 financial panic collapse, you can see that this market took from August all the way until the start of 2008 to really finally top out. And we already saw a big plunge in August 2007, which if you got short here, you had to wait all the way until mid 2008 to actually have the market get in a position where you could start making profits. um, so even in stage 3, you have to wait a while for stage 3 to take place too. So the market can bob up and down above and below the 30-week moving average while it tops out. And really, once the 30 week started declining in early 2008 and then went back up above it in mid 2008, this is where you want to start getting short the stock market. So if you look at this next chart, you can see that this kind of captures the entire bear market financial collapse, but really the ideal short entry was right here in mid 2008 when people probably thought things were getting rosy again. But the market, and actually it retested former resistance or former support back in 2007 and started to go into the massive collapse. So this is where you wanted to get short. And you can see that even this is where the panic really got started. So it didn't even retest the 30-week moving average here, but you had a great opportunity to enter the market short here, and not too far from actually the top of the market, which was already way back in 2007. If you look at what happened in 2011, was basically a fake out, and the 2011 to 2012 was kind of like a sideways bear market. But if you look at what happened, the market started topping out in 2011, crashed below the 30-week moving average, and the 30-week moving average, for the most part, just flattened out. It kind of started declining here, but really the only time to even consider shorting this market would have been right around here where it went back up and retested the 30 week. If you entered a short position there, you would have gotten this decline, but say you didn't sell or cover here, and the market rallied back above it, you probably would have got stopped out around here. Or, the key signal that the market was going back into an uptrend was that in mid 2012, the market retested the, former um, level here where it failed at and it held, and then the market continued to go higher. So by the time, if you were short from here to here, you should have interpreted this signal here that this, you need to get out of that short position, and the market is actually going to be going higher now. And from a stage analysis perspective, you can see that the market held support at the 30 week, and it's rising above it. So you wanted to get back into a bullish posture as far as how you look at the market. So this was kind of a hard market to really trade directionally, obviously, because from early 2011 all the way until mid to late 2012, the market essentially went sideways and didn't go anywhere. But the bear market was negated, so you had to keep an open mind. And if you were really bearish here, you had to change that posture based on price action. Um, Now, if you look at the current market, we started dancing along the top of the 30-week moving average all this year, but we finally pierced it with all the craziness lately. Um, but look how far below the 30-week moving average we are. I mean, this is not where you want to enter short positions in this market currently. I know it probably feels good to be on the short side because most people are bearish right now, are getting scared, but in reality, the market could decline further, but we're very vulnerable down here to a reaction back up to the 30-week moving average. And that's where, if I think about shorting the market, I'm going to wait for that to happen and, see how price action is if we don't see, any leading stocks when the market rallies back up and we see kind of more deterioration, and, if nothing kind of forms into a bullish posture, then you're going to know that this really is a bear market. But it's too late to get heavily short down here. One other thing to look at is that the number of stocks currently in the S&P 500 that are above the 50-day moving average is less than 10%. I mean, that's a horrible time to get short the market. You can see that this year, one of the key telltale signs of how weak the market was this year was just this action. We've never seen the market so weak below the 50-day moving average for so long, and this is kind of what created this topping pattern and what created this recent smash down. But with the market being down here, it's just not a good time to get short. If you look at this next chart, you can see like the 2007 to 2009 meltdown, and every time the number of stocks in the S&P 500 that got below 10%, below the 50-day moving average, was like the worst time in the world to short. So if you look at like here, I mean, these are terrible times to short the market. The best time to get short was when the number of stocks was actually like 75% or higher above the 50-day moving average, which is counterintuitive. But since the market's in a downtrend, you want to get short on strength. So that's the best time to get short. So I would look for a reactionary rally in the S&P 500 before thinking about taking a short position. But tactically, that's going to be a better time to enter shorts is above the 30-week moving average. One other thing, if you go back and look at my video on the energy sector back in April, I talked about how XLE was above the 30-week moving average, and it turned out to be an awesome time to short energy stocks because from April till now they just got destroyed. So again, hope this helps, and I'll see you guys later.